Today we're going to look at a new note-taking guide called Getting Paid. So you can see on the lesson instructions today, that's the only thing you have. You'll click on the Notes Getting Paid assignment and find your note-taking guide. Open that in DocHub. And this one is going to be 3 pages, but it'll go quick. You'll be fine. As usual, I'll let you know whenever it's time to write down anything that goes in any of the blanks. Here we go. All right, let's find a good place for me. So, 2 primary sources of employment. And these are going to go in those first 2 little boxes on the side. The first 2 little boxes on the side. Okay, the first one you'll say self-employed. Self-employed is one source of employment. And then the second box will say employed by an employer, or you could just say employee. And if you're self-employed, over to the right, you're going to give kind of just a simple definition of that. If you're self-employed, that means you own your own business. You are your employer as well as your employee. And then when you're employed by an employer, employer is the person who employs people, and the employee is the person who works for the employer. I feel like that was a tongue twister. Salary versus hourly. That was the next big blank in the middle of the page. What's the difference between hourly and salary? So salary means you are getting a set amount of money, say $30,000 a year. And then it's up to that company to maybe require you to work certain numbers of hours. Maybe they say you're going to work 40 hours a week and we're going to pay you $30,000 a year. Or maybe they're just going to say you're going to get $30,000 a year and you're going to work as many hours as it takes. That's kind of what teachers do. Yes, we're required to be in the building during certain hours, but we also kind of have to work off time in our own time just to make sure that we do a good job, and we're paid a set amount no matter what. Hourly wage, probably most of you who earn money work for an hourly wage, say $16 an hour. That's really good wage. You are required your employer is required to pay you at least minimum wage, which is set by the federal and the state governments. So which one is better? Not necessarily one better than another, but a lot of times people like to work hourly because if they work more than 40 hours, they're able to get overtime pay, which is a whole nother topic. Or you could think of it like, well, when I'm off work, and you don't have to, you don't end up overworking yourself. And a lot of people who make a salary wage will end up working a lot more hours to get that wage. So there's pros and cons. Different methods of payment. So I'm going to explain each one of these. First one, paper paycheck. So if somebody physically writes you a check or prints a check and gives it to you, and you have to go to the bank and cash that check to be able to access those funds, that's what we're talking about. You get a paper paycheck. So pros of paper paychecks is that you get money and you can then go cash it or deposit it and then do whatever you want with it. The con would be that you have to go to the bank to get that money and you could lose the check. That could happen as well. Direct deposit kind of circumvents that problem. So now instead of getting a check and having to take it to the bank, the employer is directly depositing that into your checking account. Pro, as soon as it's payday, you can start using your debit card and you don't have any other process to go through to get access to that money. But a con could be that your employer might not participate. They might not even allow you to use direct deposit. And also you do have to have a checking account for that to work. So if you don't have a checking account, that would be a problem for you as well. Payroll card is the last kind. So this is kind of like a debit card that your employer gives you a card and downloads, direct deposits money to that account. It's not tied in with your personal bank account, though. It's usually set up through the employer's bank accounts, and they're just preloading money there every paycheck, and you get to spend it just like a debit card. So pros for that, it's, functions just like a debit card. You have the money on payday. You can start spending it right away. But the con would be that there are some common fees associated with, well, I thought there was, oops, there we go. There are some common fees associated with using a payroll card at certain businesses. So you may have problems there. Second page, hopefully you're ready. This is not on the second page, but just a quick review of different ways that you can get paid. You can get paid every week, every other week. That's what biweekly means. Bi-monthly means it means twice a month. So maybe on the 1st and the 15th or something like that. And then monthly is the other way. Now, typically, people who are paid in any of these ways may be making the same amount of money. It's just that, this person is getting access to a regular amount of money every week. They only have to have their budget stretched for a week before they get a new paycheck. And this person over here, like me, has to make their money stretch for a whole month before they get a new sum of money. It looks like a big sum of money when you get it, but by the end of the month, you really have to budget a lot more for that to work. So, top of page 2, payroll deduction process. We take your gross income, which is the amount of money earned before any taxes or deductions are taken out, minus the deductions equals your net income, or also known as your take-home pay. That's the amount of money that's left over after whatever deductions have been taken out. And these are some of the deductions that are taken out: income tax, payroll tax, and the rest of these taxes are paid whenever you purchase certain items. So here's a timeline to let you know. Okay, this is why it's important that taxes are taken out of your paycheck, because starting at the beginning of the year, every time you get a paycheck, you're going to get a small amount taken out so that at the end of the year, whatever you owe to the government has been accumulating. You've been kind of like saving it up to the end of the year, instead of just December 31st, they tell you you owe $8,000 in taxes and you have to come up with that amount of money. So the reason that you get it taken out throughout the year is to save you from having to come up with a large sum at one time. Looking at income tax, there's federal and state. Payroll tax is paying Social Security and Medicare, and we're going to go over all that a little bit more. So next section on the worksheet, right under the heading that says mandatory payroll deductions. Federal income tax comes from the amount of money earned and the information on your Form W-4. So those two things are what the amount deducted depends on. And a Form W-4, that information comes from your marital status and the number of allowances, which we'll talk about next. What is an allowance? An allowance is a dependent, someone who depends on you for paying for them to live. You have a kid, you're supporting them financially. You have a aging parent or grandparent who cannot make money on their own, and you are supporting them financially as well as them living with you. That can be a dependent. It could be an adult who is disabled to the point where they cannot support themselves. So any of those things can be considered a dependent. And so with allowances, you're thinking of, well, how many dependents do I have? I have 3 kids, so I would have 3 allowances. Oops, did I go backwards? Yes, I did. Nope, now I'm going backwards. Here we go. Next, we're talking about state income taxes. I'll skip that slide. All right, state income taxes, two characteristics. Not all states have income taxes, state income taxes, and the amount that's deducted for your income taxes varies between states. Does your state have income tax? Yes, it does. What is Social Security? The purpose is for these people, retirees, people with profound disabilities, children who have lost a parent, or people who have children who have had a spouse die. So we learned a lot about that in the previous unit where we talked about Social Security. And remember that this is deducted from your wages. It's paid by you and your employer together, and that matched amount is what goes to the government to pay for your Social Security benefits when you need them. What is Medicare? This is what pays health care for people who are 65 and older, and this is also coming from your wages. Remember the FICA taxes, and this is going to be paid by you and your employer together. They match it. What are optional payroll deductions? Okay, optional payroll deductions are extra products or services that you want taken out of your paycheck. You don't have to have them taken out of your paycheck, but you can, such as insurance. If an employer provides an option for insurance, you don't have to use their insurance, but usually it's going to be more cost effective for you to get your insurance through your employer. If you're only planning to stay with that employer for 3 months, it's probably not worth your time to set it up and get enrolled and all that. But especially if you're trying to stay somewhere for a year or more, you want to get the insurance, and therefore you will be covered, and it will cost you less than if you just go out and get your own. Retirement plan is another thing. Sometimes they're going to just go ahead and contribute to a retirement plan for you and not ask you your opinion, but sometimes they will ask you to also contribute to your retirement plan. And so that is an optional payroll deduction as well. Flexible spending accounts, we talked about that a little bit a couple days ago about like a medical account. We call it health savings account, HSA. So this is money that goes pre-tax into a special kind of checking account that you can then spend on your medical expenses. So when you go to the doctor, you pay for it out of that account, and it's been able to kind of avoid taxes. What else? That answers the question for how do optional employee benefits benefit an employee? They benefit you because usually you're going to end up paying less for that product or service than you would if you were to go out and get it yourself. All right, and 4 ways that employers further support employees. Can't talk. Here are 2 of them: workers' comp and unemployment insurance. And these go in the bottom of page 2. These are the ones that have the little drop down thing and then another little blank underneath them. You know what I'm talking about? I hope so. So workers' comp, this is paying medical expenses if you were injured on the job. And then unemployment insurance is there for if you're laid off, for example, you lose your job, not because you got fired, but because the company just had to get rid of employees. They were, having money problems or whatever. They're going to lay you off, and your employer pays both of these things. So you don't pay it, but every time you get a paycheck, your employer pays for these things. And then if you need them, they're there for you. 2 other things: paid leave, so paid or unpaid days for illness, personal days, or holidays. Anytime that happens, your employer might pay your wages that day anyway, and that means, and that is coming from them, not you. And matched contributions to Social Security and Medicare. So before we talked about you pay some, your employer pays some. So this is another way that your employers are supporting you. Okay, looking at what is a pay stub. Get out of the way here. Pay stub, top of page 3. it outlines the deductions made to your wages. So this is just an example. They obviously do not all look like that, but hopefully they will all contain at least some of this basic information. For example, standard employee information like your name, ID number, address, the pay period. The pay period is right here. So on this one, it says May 1st through May 31st of 2013. So that is the time frame that we are looking at for how many hours did you work during this month, and that's what we're paying you for on this paycheck. That is different from the pay date. The pay date is the date that you actually physically get that money in your account. So you can see it's June 11th. So that is typical. You finish a pay period. It may be about a week. It may be even 2 weeks. And then you get paid again. If you get paid by the month, like if I work all of September, I will get paid for that on October 15th. So it varies, but usually you get paid after the fact, after you do the work. And that should have answered the second box on page 3. Okay. There are several places on the pay stub where it mentions current and year-to-date. So here's some current year-to-date, current year-to-date, current year-to-date. So current means whatever happened during this pay period. And then year-to-date means starting January 1st up until today, October 5th. This is how much I have earned on my paycheck or whatever. There's also going to be your gross income and your net income are going to be listed on there. So this year or this month's, I got $2,400. My year to date, $12,000. And then your net income also, remember that's how much is after deductions. This month I got $1,653. Total year to date, I've got $8,265. Your earnings are going to be spelled out exactly where they're coming up with the amount if you're hourly. If you're not hourly, it might not be quite this specific, but saying here's your rate. You get $15 an hour. This month you worked 160 hours. And so multiply those two together and you're going to get $2,400. And then year to date, so far, from January, February, March, April, May, you got $12,000. Deductions are also spelled out here. Your personal deductions, this is what's coming out of your paycheck between your gross pay and your net pay. This is what is removed. And then also is listed your employer's contribution. So notice some things. Social Security and Medicare, you pay $183.60. Your employer also pays $183.60. Retirement plan, you pay, your employer's matching it. Health insurance, you pay $100 a month, but your employer's paying $400 a month for you. And that's common too, that they're paying the bulk of it. Workers' comp and unemployment, notice you're not paying for those, but your employer is. All these deductions are taken out of the gross income. So if we added all these up, it's going to equal $747. So we say this was what you should have made, and then here's what we took out, and then here's what you actually get to spend. Okay, and answering the third question on the side, how do employer contributions benefit the employee? And here's an answer for that. Well, I guess it really doesn't answer that question. It provides benefits that you would otherwise have to pay for or you wouldn't get. Okay, another thing that's on there is your leave balance. If you're allowed, like look at this, personal, beginning balance, 10. Beginning balance current, oh, maybe that means at the beginning of this month. Year to date, 15. You didn't use any personal days this month, but total this year you've used 5. Ending balance, you have 10 personal days left. So that's usually going to be spelled out there if you're allowed to take any of those times. If, and this is talking about the bottom of page 3. So if you are paid in cash, okay. So if you're paid in cash, here's a worst case scenario. Your employer is possibly not keeping track of what he or she is paying you, and therefore they are also not paying your taxes for you. They're not keeping those out and paying the government so that you don't have to pay all those in the end. And they're also not contributing to your Social Security and Medicare for you. And then when you get that cash, you're likely also not paying your income taxes or contributing to Social Security and Medicare. So whenever you get to be older, you're going to have less Social Security and Medicare benefits. You're going to get less per month whenever you retire. And so that's going to happen. But also, if you are not paying your taxes, your income taxes all along, you are likely going to get arrested for tax fraud, and your employer may also be committing tax fraud. And so it's not a good paperwork scenario. It's much better, even if they write you a check, at least you have a paper trail of what has come in so that you can figure up your income taxes. But likely, whenever you figure up your income taxes, you're going to have to pay hundreds or thousands of dollars at one time to cover your tax liability. So it is really bad idea. Really bad idea. Now, I mowed this person's yard one time and they gave me $20. That's not a big deal. But once it gets over about $600, you really have to start thinking about it in terms of taxes, making sure you're doing everything legally. All right, I think that's it. Yes? Oh, there you go.